Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're looking at three beaten down tech stocks to consider buying as the market tests some longer term moving averages. And the three stocks we're looking at also all report next week. And those three stocks are Pinterest, Shopify, and Block, which is formerly Square. But before we get everything, remember to subscribe and leave a review wherever you listen to your podcast. And make sure to check out our Zacks.com/promo page for looking at some of our services, portfolios, and more. So before we jump into the three stocks, I just want to look over what's going on in the market. I'm recording this on Thursday, right as the market's closing. And the bullish support that the market experienced on Tuesday evaporated pretty much in the blink of an eye as Wall Street began dumping stocks on Wednesday and Thursday. This came after reports from Alphabet and Texas Instruments and Meta and many others sent the market tumbling. And then on Thursday, we saw the impressive third quarter GDP figure. Didn't really help either. So Wall Street either viewed the growth as either a sign of an impending cliff as a wave of consumer spending during the summer, or after that wave of consumer spending in the summer, or a signal that the Fed might have to commit to even higher rates for even longer. That said, the actual money is still suggesting that the Fed is all but done raising rates. So that CME Fed Watch tool, which everyone looks at, is currently placing a 99% chance on a November pause and about 75% odds on the Fed sitting on its hands once again in December. And even if it does raise rates, it's just going to be 25 basis points. Obviously, though, the mounting geopolitical fears are also fueling a wave of selling. But let's also remember that famous Warren Buffett quote that everyone talks about is, it's sometimes worth being greedy when others are fearful. So the S&P 500 and the NASDAQ are now trading below their respective 200-day moving averages, and they're reaching rather heavily oversold RSI levels that they've rarely stayed at for long over the last 5 years. And then if we look even longer term, the NASDAQ is quickly approaching its 50-week and 200-week moving averages, which are actually converging. And so the NASDAQ's 50-week moving average is pretty close to the levels we're at the moment. And then if we look even longer term, the 50-month moving average is not too far away either. So we should see investors start to possibly nibble at stocks around those levels, because the NASDAQ's 50-month moving average was last broken in the fourth quarter of 2022. And that was one of the only times in recent history it's been below that level. So with that in mind, the outlook for earnings in 2024 and 2025 remains really strong, and the Fed is near the end of its tightening cycle. So those who can kind of look beyond the near-term wave of selling and all of the things swirling around in the market that are real, legitimate concerns should possibly think about deciding to start nibbling at some stocks as we near what could be a bottom. And always remember that people are really excited to buy stocks at what often proves to be a near-term high or a near-term peak, and then really afraid to buy what will prove to be a near-term bottom. Obviously, I'm not calling a bottom at the moment, but just considering if you're a longer-term investor, it's always prudent to consider buying on the dips. So, and also on the valuation side, we should note that the S&P 500 is trading at about 17.8 times forward 12-month earnings, which puts it not too far above its 10-year median of about 17.4, and not too far above its 25-year median of about 16.7. It's also trading at about a 26% discount to its 2020 peaks. So with that in mind, we're going to take a look at those three stocks we mentioned. And the first of those is Pinterest, which trades in the ticker PINS. So PINS. It was a pandemic winner, like all of the stocks we're talking about today. And it soared from about $15 all the way up to $85 in early 2021. And it has, however, tumbled from those peaks alongside many other growth stocks as the higher interest rates began to not favor companies that were growing at all costs. So it appears that it could be worth taking a look at, though, as we head into that Q3 release on Monday, October 30th. So let's jump into what Pinterest is and then go into some more fundamentals. So Pinterest became a hit with advertisers and small businesses and users because paid content and ads kind of fit seamlessly into the platform, because people are coming to the platform to kind of share pictures and look for ideas on everything from clothing and makeup to bathroom remodels to trip ideas to what to do on a date night. And so they're not coming there for like Instagram purposes or Facebook purposes. It's pretty unique in that sense. And they have a bunch of users. So they have around 465 million global monthly users, which was up 8% year over year as of last quarter. And they've taken lots of steps to try to improve their business and focus on the bottom line. That's what all of these companies are doing. So we'll see if those pay off going forward. And obviously, they're trying to increase the money they're making off of each user by making their ads more efficient, rolling out more video, and just everything to make more seamless for their advertisers and their people trying to reach those customers. So with this in mind, we're calling for about 9% revenue growth in the third quarter, and then 90% growth in the bottom line to go from 11 cents per share a year ago to 21 cents per share. And then overall for the year, we're calling for about 8% revenue growth this year, and then another 16% revenue growth next year to get all the way up to about 3.5 billion. And then we're calling for 55% adjusted earnings growth this year, and then another 20% next year. Obviously, this does come as a huge slowdown from recent periods of growth. So it did about 52% growth in 2021, nearly 50% growth in 2020, 50% growth in 2019. So that's what all these companies were hot names on Wall Street because people were paying for this massive growth and you were growing at all costs. But then they've already suffered that big slowdown of just about 9% growth in 2022. That said, it does land as Zacks ranked number one strong buy at the moment heading into that report, with those positive earnings revisions helping it land that spot. So the stock is up about 10% in the last year, but it's now flat year to date and trading right around where it was actually when it first went public at around $24 per share. It's trading below both its 50-day and 200-day moving averages like the market is now, and near rather oversold RSI levels. The stock's also trading about 27% under its average Zacks price target. And 15 of the 24 brokerage recommendations that Zacks has are strong buys alongside 9 holds, so no sells in there at all. The company also has a really stellar balance sheet. Obviously, the reason people have not really started to dive back into Pinterest and some of the stocks we're talking about today is on the valuation front. It's still really out of whack when you look at it in terms of forward earnings. And it's trading at 4.9 times forward sales, which marks a pretty big premium compared to the broader industry of about 4.1 that it's in. So certainly worth considering putting it on your watch list heading to that report and maybe see how Wall Street reacts. But it's still maybe a little too pricey for people to dive in right now. But it's definitely now trading at levels that seem far more reasonable considering the current interest rate environment. So definitely worth maybe doing a deeper dive into Pinterest on your own and then seeing how Wall Street reacts and what its guidance looks like, especially after some rough reports from Meta and others on the advertising front. So next up is Shopify, which trades in the ticker SHOP, so SHOP. It will report its results before the market opens on Thursday, November 2nd. So Shopify stock has plummeted roughly 70% from its peaks, despite a comeback off its lows. It's been punished for slowing growth, but its outlook still looks pretty strong, and it does play an impressive role in the e-commerce space, which is still a vital part of the broader economy. So it might be time for people with some risk appetite to consider looking at Shopify as it trades for under $50 per share. So we're going to look into more about what's going on with Shopify. So it grew its revenue by an average of 65% between 2017 and 2021. And it posted even stronger growth during its first few years as a public firm. So just massive growth. The company thrived as it expanded into many different parts of the economy as more companies and small businesses and entrepreneurs just clamored for website design and marketing and digital payments and everything that Shopify offers. It also benefited from a wave of shoppers who started to flock to digital commerce amid the rise of Amazon. And Wall Street rewarded it for all of that. But obviously it was never going to be able to keep up that breakneck pace forever in terms of top line growth of posting 50% or higher growth over and over and over again. So its 2022 sales even still jumped to about 21% to 5.6 billion, driven by 11% subscription solutions growth and 26% higher merchant solutions, which was about 70% of total sales. But the tepid growth compared to the standards it had set just was not enough to justify that's still lofty valuation. So the stock has just been hammered. Shopify has aimed to help make up for that slowing expansion by doing lots of cost-cutting measures like the entire industry, as those days of zero interest rates are gone, at least for now, and maybe not coming back anytime soon. So with this in mind, the company is still set to post some impressive growth. We're calling for 22% revenue growth in the third quarter, and we're calling it for it to jump from an adjusted loss of 2 cents per share all the way up to positive 15 cents per share. And then for the full year, we're calling for about 24% revenue growth from 5.6 billion to 6.9 billion, and then another 18% growth next year. So still really impressive top line growth. And then on the bottom line, it's supposed to jump from 4 cents per share last year all the way up to 53 cents per share, and then jump another 50% or so to 78 cents per share next year. So it was really impressive growth, just not that massive growth that it was used to before that. Its earnings outlook is trending back in the right direction recently, so that's a positive sign, though it is below where it was several years ago. Overall, though, it's up about 20% for the current fiscal year over the last 60 days, and then another 19% for next year over the last 60 days. So some positive revisions, and it's crushed our bottom line estimates over the last two periods. It beat by a big margin, 133% beat last quarter and 125% beat the period before that. That said, Shopify still lands a Zacks rank number 3 hold at the moment. The stock's up about 35% in 2023 to match the broader tech sector, and it's now trading below its 50-day and 200-day, as pretty much most of the market is. As we mentioned, the S&P 500 and the NASDAQ are trading below those levels, and it's now trading below where it was in the early parts of 2020, so before that COVID sell-off. Like Pinterest, its valuation levels are pretty out of whack in terms of forward earnings. So maybe that'll change in the coming years as it continues to grow its bottom line. As we can see, that bottom line growth is really impressive. And it's trading at 7.8 times forward sales, which is pretty pricey. That's still, though, 60% below its own median, but nearly double the broader Zacks tech sector. So certainly Shopify is worth, like with Pinterest, putting on your watch list ahead of its report next week. And then you can just sort of see how it plays out in the near term and what kind of guidance it provides. So, as I said, these are all risky bets at the moment, especially as the market comes under increasing pressure. And so the last stock we're going to look at is another one of these risky names whose growth days are far behind it, and the stock's been hammered for that, and that is Block, which trades in the ticker SQ. Used to be called Square. The stock's tumbled actually 85% from its peaks. Wall Street dumped the credit card reader and financial tech standout on the back of those rising interest rates, consumer spending worries, tough to compete against periods, increased competition, and more and more. The company also faced some selling earlier in the year after a well-known short company. So Hindenburg Research likes to short a lot of companies. They said they were shorting Block, alleging that it had inflated user metrics and didn't rein in illicit activity by users on the Cash App. The company disputed that, so that's not really a big part of the reason why it's down. Just worth pointing out that was a big story earlier this year. So with this in mind, Block is set to report its third quarter results on November 2nd. So let's kind of jump into the broader business and then some other fundamentals. So its portfolio includes a range of point-of-sale offerings, broader payment and software infrastructure, business loans, peer-to-peer payment, Bitcoin transactions. The goal of the company kind of broadly is to be a digital native banking and financial services company for both consumers and businesses. And it really is an impressive company overall. And then it made a big splash into that once hot buy now, pay later space when it bought Afterpay for about $29 billion in an all-stock deal that closed in early 2022. Wall Street at the time feared that it overpaid, having bought the firm right when tech valuations and consumer spending were peaking. So that certainly does seem to have proven to be the case, especially in that super hot buy now, pay later space as interest rates rise. So Block is coming off an impressive run of top-line growth that included 86% sales growth in 2021, 102% growth in 2020 that saw it climb from about $4.7 billion in 2019 to $17.7 billion in 2021. So just massive back-to-back years of growth. They were never going to be able to compete with that growth. So they actually saw their revenue decline about 1% in 2022. So with this in mind, though, we're calling for about 20% third quarter revenue growth, and we're calling for about 5% adjusted earnings growth. And then for the year, we're calling for 22% revenue growth, to get up to about $21.5 billion, and then another 12% sales growth next year. And then on the bottom line, we're calling for 69% adjusted earnings growth from $1 to about $1.69 per share, and then another 37% adjusted earnings growth next year. So solid growth on the bottom line for all the companies we've talked about, but just not there yet in terms of valuation. Though, unlike some of the companies in the tech sector, its earnings estimates have held up rather well. It currently lands a Zacks ranked number 2 buy at the moment. And 21 of the 35 brokerage recommendations that we have are coming in at strong buys. 2 more are sitting at buys and the rest are sitting at holds. So no sells here overall. So Wall Street still remains rather high on the stock long term, and it's trading 86% below its average Zacks price target at around $41, around $42 per share, I guess you could say. The stock's also firmly below its 50-day and 200-day moving averages, and it's now actually approaching its COVID sell-off lows, with it down about 40% in the last 5 years. It's like all 3 of these stocks, its forward earnings are pretty out of whack, but it's trading at just 1.1 times forward 12-month sales versus the broader Zacks tech sector's 3.5. So maybe worth more of a look on the valuation side. And it's trading at well below its own 5-year median of 5.1 times forward sales. So certainly worth considering putting block on your watch list. Like all these stocks, I'm not recommending trying to kind of catch a falling knife or bottom feed on any of these stocks, but they run pretty viable businesses. We'll see if they can hold up. The broader worry is basically higher interest rates are just going to hammer all these stocks even more. As we can see, their valuation on the earnings front is pretty bad, pretty out of whack if you look at our metrics there. So certainly worth looking at both, or all, I should say, Pinterest, Block, and Shopify after they report and see what the guidance looks like, and then see how Wall Street reacts to the stocks. Because overall, we could see buyers possibly start stepping in soon, especially if we reach some of those longer term moving averages for the S&P 500 and the NASDAQ. So that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.